The Magnificent Seven.
777, the Magnificent Seven.
No, not that Magnificent Seven. What I'm talking about are 7 really strong stocks we can all invest in today. This term was really coined by Michael Hartnett, an analyst at Bank of America. And I'll show you what these stocks are in a second. But I have to say this before I get into this video. These are all strong companies. And if you invest in any of these, you will probably continue to beat the market. So in this video, I'll actually determine who's the best of the best out of the 7. I'll actually go in reverse order. But first, let's take a look in Tykr so we can see what this list is. This is not the order I'm going to go in. I'll show you what the order is just so you can see how Tykr works. So what I did is I created a watch list just titled Magnificent 7. And you can see here those 7 stocks. Now what I did is I sorted these by the summary. If you guys don't use Tykr, what it does is really put stocks into 3 different categories: on sale, watch, and overpriced. On sale is actually pretty hard to achieve. You got to have a strong company overall. Then you have watch, that's that middle ground, and then overpriced. Most cases, those are stocks you should run away from. But I will give you context on the order I selected. And what I'll be doing is using what we call the 4M checklist or 4M confidence booster. This is a new tool that we're adding to Tykr. It'll be powered by ChatGPT to pretty much do all those M's for you. On a high level, here are those 4 M's. So the first M is the margin of safety. That really encompasses the math part of investing. In Tykr, it's that summary, score, and margin of safety that roll up to that margin of safety category of that first M. So we like strong stocks, financially strong stocks overall. The second M is the meaning. That's the business model. How many different revenue streams does the business have and how scalable are those revenue streams? Scalable would mean you can increase your revenue a lot faster than your liabilities. Big liability would be payroll. So we like businesses that can be highly profitable. Then you have that third M, which is the moat. How does a company stack up against other companies in the same sector and industry? We like businesses with a wide moat because they're harder to duplicate. And then the last M is the management. That's the track record of the CEO or leadership. I'm not actually going to do a thorough 4M analysis with each stock. I'm going to touch on the first M, that's the margin of safety, and then the second M, that meaning the business model. I may touch on the moat a little bit, but probably not too much. And then I'll probably skip the management. When you invest in stocks, I still recommend you look at all 4, use the 4M confidence booster. But in this case, trying to find out who's the best of the best out of the Magnificent 7, I'll really focus on those 2 M's. So let's get to it. Number 7, I'm actually going to start with Amazon. And the reasons are, number 1, this stock is overpriced. It's still a strong company to invest in, but the financials, we want to see improvements there. Now, this stock is a little bit behind financially or a little weaker financially because we just came out of a recession. Some would say recession, some say bear market. I would say recession. It was really between November of 2021 through about March of 2023, about a year and a half. And what happens during recessions, and I remember this vividly from 2008, a lot of companies pull back on marketing and advertising. So companies like Amazon, that makes money in advertising, Google, and Meta, they all saw lower profits, which means their score and a margin of safety are going to be a little lower. But what happens is when you come out of a recession, businesses have to make up for lost time. So it's kind of like a slingshot. They're going to let that fly and they're going to be spending a ton of money to make up for lost time. So we can see Meta, Google, and Amazon seeing pretty strong 2024s. But this doesn't mean it's the top stock in this list. Amazon really makes a lot of money on e-commerce, and I like e-commerce, but I don't love e-commerce. Here's why. With e-commerce, you have to manufacture physical products, and then you have to ship them, and in many cases, you have to store them. It's a lot of, not waste, but it's a lot of overhead. Compared to SaaS, software as a service, where you are selling something every month, it's air. There's nothing physical, you don't have to manufacture something. So if supply chain gets interrupted or manufacturing gets interrupted, a lot of businesses will slow down sales, which means Amazon will take a hit. What I do like about Amazon is AWS. That's that large enterprise hosting platform. I think it's great. I also like that they've acquired about 115 companies over the last few decades. When you get to a business size where you have a lot of free cash flow available and you can buy other businesses to turn into new revenue streams or new products, that's a great place to be. So Amazon is in that category, but overall, weaker financials and the e-commerce play, that's why I consider this stock number 7. Doesn't mean it's a weak stock. It's just, it's going against some really strong companies here. Okay, number 6 on the list, Meta. Now, just to take a step back, when I think of scalability, top of the food chain, I would say would be advertising. Next would be payment tech. Next would be SaaS, software as a service. In that same third category, I would also put infrastructure as a service or platform as a service, which that would be more servers and like AWS, like I just mentioned, when Amazon would fall into that more platform as a service. But with SaaS, products like it, like infrastructure and platform as a service, it's a reoccurring fee. It can vary a little bit, but it's usually the same price every month. Think about Netflix. I pay Netflix about $15 a month. I'm not paying any more. And that's great because it's reoccurring, but it's not as scalable as payment tech or ad tech. So with payment tech, think like PayPal. It comes in between the buyer and the seller, transaction fees. And those customers can make 10 purchases a month, 20 purchases a month, 30, and those fees just rack up. There's no limitations, and we like that. We like those businesses with that scalability with no limits. Ad tech can be very scalable. You get companies that are spending, let's say they're spending $10,000 this month, then they realize they're profitable. Every dollar they put in, they're getting $2 back, for example. Guess what? They're going to dial that up to 20,000, 30,000. Bigger businesses, they're not dealing with tens of thousands, they're dealing with hundreds of thousands of dollars, on up to millions of dollars they're spending on advertising. And that's why ad tech is top of the food chain. Now, Meta, that's it. They make their money in advertising, but that's pretty much the main revenue streams. So like we've seen in 2022, when you hit tougher times and people pull back, Meta takes a big hit. Google did as well, but we'll get to Google in a minute. But that's the reason why I don't have Meta higher on this list, because they don't have multiple streams of revenue, or as many. They do have a few streams, but it's primarily advertising. And that's why in this case, I'm putting them at number 6. All right, number 5, Nvidia. So I like Nvidia and AMD, 2 really strong semiconductor stocks. I actually invest in AMD. Semiconductor chips are in everything. Cars, microwaves, refrigerators, cell phones, TVs, list goes on. Now, the issue I have, not a big issue, but a reason I don't like Nvidia more than some of the other companies here, you have to manufacture and ship chips. So you have plastics, aluminum, silicone, these little pieces that you're putting together. And if there's a disruption like we saw during COVID, it can slow down manufacturing. We actually saw that with automobiles around the globe. There's a slowdown there. There are other products as well that hit a slowdown. So that's the risk with this business model. Still a very strong stock. In fact, Nvidia, it actually returned over 200% in 2023 compared to the other stocks in this list. They're not that high. It's actually the top performing stock on the market, but not the strongest in my opinion for the long term. If you're a long-term Nvidia shareholder, you'll probably still do very well, but these are strong companies it's going up against. So overall, the manufacturing of chips, that's the reason why I have to put this stock at number 5. Okay, number 4, I know I'm probably going to get some heat on this one. Sorry, Tesla investors, I got to go with Tesla. So Tesla's a strong company. Their financials are outstanding. On this list here, looking at my screen, they're on sale. Only 2 out of 7 actually made on sale. They have the highest score as well at 83. Their margin of safety would be second place at 55% compared to Apple at 75%. So looking at Tesla's site, sure, electronic vehicles, that's great. But they also make money on solar roofs, solar panels, power walls. The big one is charging stations. When you create a product that your competitors use, you know you've created a solid company, and that's exactly what happened to Tesla. There's a lot of other companies, electronic vehicle manufacturers, that are going to be using those power stations, Tesla's power stations. That is awesome. Now, here's the risk with Tesla. Tesla investors, you're probably going to continue to make some solid returns over the next few years, probably next 2 or 3 years or so. So nothing to sweat right now. The issue is there are a lot of EV manufacturers around the globe, and they're ramping up, and they're going to take away market share whether you like it or not. So for example, in Europe, VW, the ID.4 is very competitive to the Tesla 3, very similar in price and size vehicle. It's taken market share away from the Tesla 3. We are seeing GM and Ford start to ramp up their production and their vehicles. It can come in pretty low price. Doesn't mean they're better quality than a Tesla. Tesla, in my opinion, would be a better quality vehicle all day. But there's a lot of EVs entering the market, and they're going to take market share away. The sleeping giant, the big monster that everybody needs to be afraid of, I'm going to say right now, is Toyota. Toyota has proven to make long-lasting, strong, reliable vehicles for decades, without a doubt. And they've kind of not took a back seat, but they wanted to see where things are going because they're hedging the downside. To explain what that means is they are really focusing on 4 different types of vehicles: gas, hybrid, electric, and hydrogen. They want to make sure that whatever really takes off the most, they're prepared to scale in that direction. That's a smart business play right there. Now, I will say this, hybrid sales for 2023, they just grew significantly. So Toyota's capitalizing on that. Well, when it comes to EVs, this is the big play. If you guys didn't see another video, I talked about this solid state, lithium ion solid state batteries. Instead of approximately 300 mile range, we're talking 700 miles to start on up to 1,000. And a charge time of 10 minutes, ridiculous. And the top company that's focused on solid state is Toyota. And the problem is it's very expensive to manufacture. So that's why we're looking at about 2026, 2027, when they could really flood the market with solid state vehicles. And Elon Musk has mentioned that Tesla is not going to use solid state. They're going to rely on their own tech. We'll see where Tesla goes with that. So just keep that in mind. Long term, Tesla, you might have a little bit of a threat. I think investors out there, you're still okay, still good. But that's why the EV threat from other companies, I'm putting them at number 4. Okay, into the top 3. Here we go. Apple at number 3. All right, I really like Apple overall. As you saw here on my screen, the stock is on sale, scores 61, and that margin of safety is 75. This is a strong company, but I like that this company has multiple streams of revenue. You have the iPhones, of course, top selling phone around the globe. You've got iPads, you've got the MacBooks, which are powered by those M chips, the M1, M2, and I think the M3 will be coming out soon. Just, they're game changing. I went from a PC, can't believe it took me this long to switch to Mac, went from PCs to switching to the beginning of 2023. I've got a MacBook here with the M1 chip. We're talking rendering time for video would take hours down to like 10 minutes. It was ridiculous. The speed is just beyond anything I've seen before. And then this is big. They have the Apple services, which includes Apple Card. They've got the App Store, Apple Pay, and other services within where they're not selling a physical product. I did mention you've got Nvidia, which you're manufacturing chips, or anything that's manufacturing a physical product, I consider a little bit of a risk. But we're talking smaller units here with Apple, not a whole vehicle, but smaller units, the phones and the tablets and the MacBooks. So there's the physical products, but then the services revenue, and the services revenue has grown to 20% of their overall revenues. It's incredible. And this company has proven to be a great performing stock for a lot of people for the last few decades. They also have a strong brand moat. People are diehard fans of Apple. In many cases, they switch to an Apple product. They don't switch back to something else. Overall, I love Apple. I'm a long-term investor in Apple. But overall, 3 main reasons I really like Apple. At number 3 on this list would be strong financials in Tykr. Number 2, multiple streams of revenue and really strong brand moat. Okay, down to the last 2. Who's it going to be? All right, at number 2, I will say Google. All right, so Google, they have advertising. I talked about that with Meta, highly scalable revenue stream. Well, you have Google and YouTube. And then get this, Alphabet, I always say Google, but it's really Alphabet. They actually have acquired something like 250 companies over the last few decades. And those companies have either turned into new products or new businesses that are creating additional revenue streams in the company. This company is highly scalable in a lot of different revenue streams. It's like Meta on steroids, essentially. They also have Capital G, which is a private equity firm within the company that acquires or invests in other companies, other tech startups, and then is making money on those. And if any of those companies go public or sell, Google or Alphabet is making money on that. So this company overall very strong. Looking in Tykr, you can see here they're a watch. Their score is 50 out of 100, margin of safety is 0%. That's because people pulled back on advertising in 2022, 2023 a little bit as well. Things are going to rocket here, take off again for Google, Meta, and Amazon. I'm a long-term investor in Google. Again, I really like all those streams of revenue. This is overall a really strong company to invest in. And that leaves us with one more stock, Microsoft. Now I consider Microsoft to be, I've said this before in other videos, the perfect business model. They have a nice balance between enterprise SaaS, consumer SaaS, hardware products, and various other revenue streams. So they've acquired about 200 companies over the last few decades, not as high as Alphabet, but still really good. But just to kind of break things down a little bit, Microsoft Office 365, businesses run on this. And when you work at the enterprise level, let's say you work for a company that has 100,000 employees, every employee has a license, and those numbers add up. And that's when those contracts can be, we're talking hundreds of thousands of dollars on up to millions of dollars per year. And with Microsoft 365, a company's never going to have the conversation and say, hey, we want to cut costs, so we're going to, you know what, let's cut our Microsoft Office 365 costs. That's never going to happen because businesses, again, they run on it. It is the perfect SaaS product. Then you get to Microsoft Dynamics, which is an enterprise level software that it's like an ERP, which can do like accounting, supply chain, keep track of manufacturing. It can do a lot of different things. And that is another product that, again, one customer can be paying hundreds of thousands of dollars on up to millions of dollars per year. Microsoft has Windows operating system, which is installed on over 70% of the computers around the globe. So they're making money on that. Have LinkedIn, which makes money on advertising and subscription. They also have Microsoft Azure, which is competitive to AWS. Large companies use Azure for hosting all their software. Then you have hardware products like Surface. And you have video games, Xbox. They just acquired Activision. And like I said earlier, 200 other companies they've acquired that are rolling up to new products or businesses that are creating additional revenue streams. And then on top of it all, you have their investment in OpenAI. OpenAI is now integrated within Azure. There's other tools that are being used and rolled out as well. They are poised for a huge future. This has been one of my top stocks over the last few years. I will continue to invest in Microsoft, but there you go. That's why Microsoft overall, the strongest company out of them all. They maybe didn't produce the biggest returns in 2023, but for the long term, this is the play. That's why I put Microsoft at the top of the list. Okay, to recap from top to bottom, 1 to 7, Microsoft, Google, Apple, Tesla, Nvidia, Meta, and Amazon. I said it before and I'll say it again. These are all strong companies. You'll continue to do very well in the market if you invest in any of these, but this is how I would rank them from top to bottom. If you guys like this video, hit that like button. If you want to see more videos like it, hit that subscribe button. And if you want to find some strong stocks to invest in and maybe avoid some weak stocks that can lose you money, I invite you to join Tykr for free.